This has been one of the brutal years the stock market has seen in a long time. Investors are panicking, portfolios are deep in the red, and confidence is at the all-time low. And at the center of all the blame, President Trump and his latest wave of aggression tariff. Some experts are even warning that we could be heading into the worst quarter since the COVID crash back in 2020. Here is what most people did not realize. The bigger the crash, the bigger the opportunities. While everyone else is selling in fear, this could be your moment. You're short to build a serious wealth and get ahead of others. In today's video, I'll walk you through what is really happening in the market, how far stocks could realistically drop, and which one could explode in value once everything is settled. When the market crashes, most people panic. We see discounted stock and we go shopping. Remember, be fearful while others are greedy, and greedy while others are fearful, by Warren Buffett. Let's not forget, real bear markets are rare and they don't last forever. On average, bear market lasts 11 months, down 32%. Bull market lasts over 4 years, up 150%. When you are deep in bear market, it feels like it never ends. But the truth is, every past crash looks like an opportunity. Every future crash feels like a risk. When everyone is doom scrolling, you should be deal hunting. Right now, the fear and greed index is flashing extreme fear. But don't get fooled. It's just a short-term panic. Long-term fear, that is when people at cocktails party feel sorry for you for being in the stock market. That is when we strike. These are the top 3 stocks that I'll be looking at in my watch list. The first stock will be Google. It's an undervalued tech titan. The business overall, Google primary company Alphabet dominates several key sectors. Google Search still holds over 90% global market share. Advertising, Google Ads, YouTube Ads generate a massive portion of revenue. YouTube evolving into a full-fledged streaming and content platform. Cloud, Google Cloud Platform is now profitable and growing fast. Moonshot, like DeepMind, is going for future breakthroughs. The cash flow and fundamentals of Google produce tens of billions in free cash flow annually, boasting a fortress balance sheet over 100 billion in cash, and has minimum debt. And they are also buying back shares consistently. When we base on the intrinsic value estimates for Google on Morningstar, it will be $211. However, you will need to do research and do your calculations on the intrinsic value for Google. At conclusion, at a current price of 153, you are essentially buying Google at a discount to its fair value midpoint. It's a strong candidate for long-term investor who want growth at a reasonable price. The second stock will be Nvidia. The business overall, Nvidia is the backbone of the AI revolution. Its chips are used in AI modeling training like ChatGPT, data center like H100 or A100 GPU, gaming like GeForce GPU, and automotive for self-driving platform. They also have aging computerized and monoverse. There's no denying it. Nvidia revenue and profit have absolutely blown thanks to the surging AI demand. But here's the catch. Profit margin are at record high. Can they really go much higher? Competitors like AMD, Intel, and even custom chips from big tech companies like Google TPU or Apple are catching up. Expectations are sky high, and Wall Street doesn't forget even small misses. Valuation, what it's really worth. According to the Morningstar, the intrinsic value estimate for Nvidia is 169 per share. At the time of this recording, it's traded at around 105, meaning there could be value here, but that is if the AI wave continues strong and competition doesn't eat into their dominance. Always do your own due diligence and research your own intrinsic value based on your assumption. The third company, Microsoft, the quiet compounder. Business overall, Microsoft has quietly become a top-notch tech compounder. They are behind the cloud, second largest behind AWS, enterprise software like Office 360, Teams, and Dynamics, AI leadership like OpenAI partnership, and gaming like Xbox. The fundamentals of this company have massive recurring revenues, excellent margin, consistent free cash flow, and smart capital allocation, including their buybacks and dividend. Microsoft rarely makes major missteps. According to Morningstar, the intrinsic value estimate for Microsoft is 498 per share. Now, don't just blindly follow that. You should always do your own calculations of the valuation too, using methods like discounted cash flow, DCF, or even basic PE analysis. But that estimate gives us a reference point. At current levels, Microsoft may still have upside for long-term investors. Here is what exactly I'll be doing in the market. Number one, selling cash secure put. Instead of just sitting on the sideline, I'm getting paid to wait. By selling put on high quality companies I already want to own, I collect premium income and position myself to buy them at a lower value if they dip. It's like setting a limit order and getting a paycheck for it. Example, if I want to buy Google at 130, sell a 130 cash secure put, getting paid upfront, and if it drops, you are buying it at your target. Watching the 52-week low list, this is where hidden gem appear. When stock hit or approach their 52 weeks low, it signal extreme pessimistic, and that is often where values live. I'm not saying to buy blindly, I'm just saying start your research there. Look for great companies whose price have dropped more than their fundamentals warrant. Letting data drive my decision. You have to let your research drive your decision. No panic, no hype, no CNBC noises. You run your own research, and based on your valuation, to see whether this stock is cheap enough. But cheaper price doesn't mean you have to get in the stock. Do the math, demand a margin of safety. If the return isn't there, I wait. No FOMO here. This market might be volatile, but that is where real wealth is built. Stay strategic, stay patient, and when fear spikes, react on it. Like Warren Buffett say, be greedy while others are fearful. This isn't just about picking stocks. This is about mindset, it's about preparation, it's about discipline. Crashes doesn't destroy wealth. Emotional decisions do. Turn off the noise, ignore the headlines, forget what CNBC is screaming. Instead, zoom out, think long term, and focus on buying great companies at great prices. Not just when it's easy, but especially when it's hard. The 2025 crash may just be a gift. Don't run, don't flicker, just smile and say, perfect, I've prepared for this, and let's go find some good deals. If you find value in this video, and if you are serious in building wealth while others are fearful, do me a favor, hit the like button so that more people can see this video. Subscribe for clear and no hype investing content for every single week, and tap on the bell notification so you never miss an opportunity when the market moves. I'm here to help you invest smarter and not louder. If you are interested in option trading, I do have a video explaining step by step of option trading for beginners. Thanks for watching, and I'll see you in the next one. Until next time, trade smart and stay profitable.